Richard, before you go, let me get your assessment. You're one of the big titans in real estate in the country. Where are you seeing right now? Can you assess real estate and the economy for us right now? We know what the markets are thinking. You know, they want tax reform. They're up 15%. They think we're going to get it. How would you characterize things right now?
Well, there's two things about tax reform. Some of the things that have been mentioned by the House Ways and Means Committee on tax reform are pretty radical in the real estate business. So I think the real estate business is kind of holding its breath right now, not knowing exactly what's going to happen.
Because a lot of tax breaks go away.
Because, for example, they have some mention where interest will not be a deductible expense. So some of these things in real estate could be quite dramatic. In general, the real estate business is healthy, and it's healthy because the banks have been underwriting things in a far more conservative way. Risks now are being borne by parties that should be bearing the risk. That's, you know, private capital, hedge fund, private equity, sovereign funds, institutional investors, and I think that's correct. Generally, the business is healthy, and the business really depends on job creation and family formation. So if we have good job creation and we have good family formation, then that's going to bode well for the business.
And it's funny because it's a cycle. When you get tax reform to improve jobs, you've got to get job creation to improve real estate.
I was asked, you know, we've been living off low interest rates for the last several years, and somebody asked me, you know, if I thought, you know, a quarter of a move or a half a point move in the Treasury was going to change things. And my answer was, you know, the people who invest in real estate and rely on that very low-cost financing better grow up, okay? Because it's been, you know, we've had a little bit of a party the last few years because rates have been so low. But when you do these projects, you have to do them in a way that they normalize the cost of your capital. And so I'm not sure that that's going to have that big an effect on the business. However, dramatic changes in the tax law in Washington will.
Yeah, for sure. So is it your sense that once we get higher interest rates and we get a tax reform package that includes what you're talking about in terms of real estate, the real estate market slows down?
Oh yeah, if we get a double whammy, we're going to feel it. But it's again always the marginal player that feels it. It's the undercapitalized developer, undercapitalized owner who's going to feel it.
Phenomenal insights from you, Richard. Thank you.
Thank you.
Good to see you. Richard LeFrak joining us there.